everyone. This is Laura Sellards, and I'm sorry my camera is not working this morning, but we're excited that you can join us. We have Lawrence Yoon, who's the Chief Economist and Senior Vice President of Research at the National Association of REALTORS. He oversees and is responsible for a wide range of research activities for the association, including NAR's existing home sales statistics, affordability index, and home buyers and sellers profile report. He regularly provides commentary on real estate market trends for its 1.4 million realtors. Dr. Yoon creates NAR's forecast and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He appears regularly on financial news outlets, is a frequent speaker at real estate conferences throughout the United States, and has testified before Congress. He also participates in the Industrial Economics Discussion Group at the Joint Center for Housing Studies of Harvard University. He has appeared as a guest on C-SPAN's Washington Journal. Dr. Yoon received his undergraduate degree from Purdue University and earned his PhD from the University of Maryland at College Park. And we are so fortunate to have him talking with us locally today. So welcome, Dr. Yoon.
Thank you, Laura, for the introduction. And I'm glad that this meeting can take place because, we are all stay in shelter or have stay in shelter. I am certainly working from home. Our office, which is just 2 blocks from the U.S. Capitol, right now is boarded up because the National Guard is still out in the D.C. area. But what a year in 2020. Despite all the challenges that occurred, the housing market has been one bright spot for the economy, or I should say one of the bright spots for the economy. Online shopping, they has done tremendously well. But it was very good that at the time of uncertainty, if you remember back in March, April of last year, we really did not know, how bad this virus situation is, along with, what's going to happen to the business condition. But things have really turned for the better. And in 2021, the question is, should we anticipate continuing momentum? Or with mortgage rates now beginning to show some signs of upward pressure, will this begin to cool off the super hot housing market? So let me go into those discussions, but I want to thank Laura and rest of the leadership team because we get feedback information through all the community channels, local association, state association, then eventually to National Association about some issues. And one of the issues that we heard from you was about the rental subsidy. With the eviction moratorium in place, how is the landlord, and for the vast majority is small mom and pop who own 1 or 2 properties, who have relied on rental income for their normal finance, but if that doesn't come in, what happens? So we really push hard on that issue, and that thankfully the latest stimulus measure that was passed include rental subsidy so the landlord can cover the rents rather than being left out. So thank you again to Laura and all the local association leadership. So let me go into my presentation. I speak better with PowerPoint slide. So let me put that onto the screen. So here we are. So let me first start from the very broad economy, the job market. This is a 20-year chart that shows on what happens to the U.S. economy and also during the pandemic. The first decade, from year 2000 to 2010, what you see is artificial job creation due to the subprime lending, those funny mortgages that overstretch people's budget. And then it was adjustable rate mortgage, so it began to reset at higher interest rate, and people simply could not afford, and it imploded. So we had the foreclosure crisis. But from the low point in 2010, America experienced the longest economic expansion ever. You can say President Obama, President Trump, tremendous, such that January of 2020, essentially this time last year, report from Wall Street company, Goldman Sachs, said U.S. economy super strong, momentum intact in a presidential election year, nothing can derail the U.S. economy. So that was the research report right before the pandemic. And of course, the whole world turned upside down once the virus began to spread. And in a single month in April, 10 years of progress gone, 10 years of job creation disappearing in a single month in April. It impacted tourism very, very hard. People in the restaurant industry, along with hotel, and certainly in Eagle County, you would have initially felt some quite a devastating impact of the lockdown. But as the economy began to reopen, jobs began to come around. But you see on the chart, we are only halfway recovered. We need another 10 million jobs just to get us back up to the pre-pandemic level. Let me put the graph in more shorter time span to hone in some of the discussion. So April is when we lost that 20 million jobs. Then the stimulus measure passed. So the enhanced unemployment insurance, the $1,200 check, so it provided some support for the economy. But note how the economy was fizzling out October, November, December, which was the reason why President Trump in late December signed into law the second stimulus. That is why everyone has that $600 check into your bank account already. President Biden is saying that is insufficient. He wants to raise the amount for additional $1,400. It looks like it's going to pass very quickly. House of Representatives, I think they're voting today, and the Senate would simply take that on, and it will pass. So for most Americans, they will get another $1,400, along with the extension on the unemployment insurance, small business loan, another measure, trying to restart the economy as things were fizzling out. Now, the second half of the year looks very bright because of the vaccination. Every single day, about 1.5 million Americans are getting vaccinated. So tomorrow, another 1.5 million and so forth. And health experts believe that about half of Americans will be vaccinated by summer, another quarter by autumn. At that point, we are in a herd immunity. We can now enjoy indoor restaurant dining, go see the Broncos game in person, tourism, all that will pretty much begin to slowly recover and that sense of normalcy in the second half of the year. But how do we get to the second half from now? It is really due to the stimulus measure trying to push up the economy with government spending, cash payments to many individuals. If we look at the job market in Eagle County, interesting difference compared to the US. So what this chart shows is that you really never had a big downturn foreclosure crisis in 2008, 2009 period. There was some degree. I know there was in Denver, but in Eagle County, the jobs were not really that impacted. And steady job growth, and then lockdown, and I'm actually quite surprised, given the tourism dependency in your area, that you did not come down as sharply as before. But from the low point, you are seeing that it's not climbing either. So it's not yet climbing back up to the pre-pandemic condition. But one looks at the Denver market, because many of the people who could potentially buy second home or visit the area and resuscitate the economy in Vail will be coming from Denver. So what you see in Denver is that the first 10 years of this century, from the year 2000 to 2010, no real movement, then foreclosure crisis. But from 2010, it really took off. So anyone who was homeowner in Denver from 2010, they are smiling big time because home prices were rising, and they were enjoying this job growth, home price appreciation. Note the lockdown and recovery. Denver is almost getting there to the pre-pandemic level, and certainly a good trending related to the job market. And another point of note is that if you look at Denver versus the U.S., look how far you are above the red line. That shows that Denver area had a faster job growth compared to rest of the country. If we look at the 50 states, we see this variation. Colorado down 5.4% in terms of total jobs from 1 year ago. So you can say pre-pandemic versus now. I don't know all the specifics of Colorado, but if you look at the nearby states of Idaho and Utah, they actually have more jobs today compared to pre-pandemic. Those are the only two states with job creation. If you look at New York, Michigan, down significantly, California down significantly, but southern states are down more modestly. So what explains for the difference? Well, the biggest contributor to some of the variation is really related to the governor policy on the lockdown. Do you have a very strict lockdown for a longer period, as Governor Cuomo did in the New York State? Or do you have more lax lockdown? In Utah, the governor said, look, coronavirus is very dangerous, but we will not shut the economy down. We cannot. So please be careful out there, put on the mask, follow social distancing measure. So depending upon the policy variance, you see the difference in the outcome that is occurring. One unique aspect of the current recession is also the following. We were in a downturn, GDP, total production in America down 8.5% in the second quarter of last year, still down in the fourth quarter. But if you look at the right-hand column, personal income is actually higher. This is the first recession in US history where average Americans have more income during a recession compared to before the recession. On average, I know very well of families in food bank, struggling paycheck to paycheck if they have a paycheck. So I know, worried about their next housing payment. So certainly there are many families in that situation. But nonetheless, on average, first recession ever where Americans have more income now than before. So what are people doing with this extra income? Which is coming from stimulus measure, enhanced unemployment benefit, small business loans, which people do not have to repay if you meet certain criteria. So what are people doing with this income? They are saving it. They're not spending into the economy. First, restaurants are closed. You cannot go see ball game in person. Less opportunity to spend, so savings are high. It also means all these savings could be unleashed as a spending once we reach herd immunity in the second half of the year. So the second half of the year looks to be very good in terms of the economic prospect. Just trying to get to the second half is where the stimulus measure is coming in to see if that can be supported. In the meantime, housing market made a dramatic U-turn. April, May, I'm sure you are all concerned. What's going to happen to my business? Should I switch career? Big concern. But once the economy opened, consumers said, I want a home. I want a larger size home. And they were also facing record low mortgage rates. So home sales quickly recovered and then some, rising way above pre-pandemic levels. One of the few sectors doing exceptionally well throughout 2020. And if we look at where people are buying, essentially there's bigger increases in the upper price range. So say $1 million home, maybe 30 of $1 million homes were sold in 1 year. Now it is 60, whatever locality it is, so nearly doubling. If you go down the price point, there's far fewer transactions. And the reasoning for fewer transactions or less growth in the lower price point is there's no inventory. Just lack of inventory is frustrating sales at the starter home market. But on the upper end market, because of sufficient inventory, sales are clicking. And also the desire to have more larger size home is also an influence as to what's going on. Because of the strong demand and people buying upper end homes, the median price are rising at double-digit rate of appreciation. Nationally, it is up about 13%. In the Eagle County area, I believe 20%, so doing much better than the nation in terms of the transactive value, because there's something special related to consumers' desire to have larger size home during the pandemic and possibly going into the future. Also, the fact that we don't have sufficient inventory, especially for the starter home, is leading to a lot of multiple offer situation. So it's creating a lot of friction, and certainly people who win the bid, they're happy. Home sellers are happy, but it's still a lot of frustration because multiple offers by definition means multiple losers. So realtors working with the clients who did not win the offer, you have to start over the process all over again. So very, very frustrating, and it's hindering the sales. If there is more inventory, certainly we would have more transactions. So what is the prospect of getting more inventory? Well, the prospect is beginning to turn for the better. I will not say that we will have any balanced market in 2021. It's going to take maybe 2 or 3 years. But the builders are beginning to ramp up production. Blue bar, that's single family new housing starts. And after 3 or 5 months, it becomes a completed home ready for sale. This is actual start, which declined in the latest month, but that was more related to the winter snow effect. But the housing permits, the document to build a home, that is consistently rising, and therefore the builders will be ramping up. Now, they will put a clause in to say that if lumber prices rise, I have to jack up my prices a little more. So even as they are signing contracts, the final price is contingent upon what the lumber prices are, because there's quite a challenge related to the lumber prices rising very, very fast. Condominiums and the apartment building, it is fairly neutral, neither increasing or decreasing in any meaningful way. So what is the likely path for home sales in 2021? First, I believe in the first quarter, you can anticipate about 20% growth in unit sales, 20% growth in unit sales in first quarter, based on pending contracts, mortgage activity, and the fact that there's multiple offers, meaning that people were lost, they will reach out, try again. Second quarter is an eye-popping about 50% growth in unit sales. And you shake your head and no, that's not possible. But then you have to remember, second quarter of last year was a lockdown, so it's comparing with a very low base. So it's a somewhat artificial comparison, but the figure comes out to be about 50% growth. Third quarter, virtually no change from 1 year before, and fourth quarter actually lower, slightly down from 1 year ago. If you assume that this would be the case, what happens is that in 2021, home sales, this is the unit sales, would be up 15% from 2020. So this is a very good outlook as to the prospect of more transactions in 2020. Again, just the logic, first quarter almost guaranteed 20%, second quarter huge increase because you are comparing at the low base, and the third and fourth quarter, assuming no real change, you are getting this big bump. One concern is the following: rising mortgage rates. Now, I did incorporate in my forecast for higher mortgage rates, about 3.1% average in 2021. So I already have that into the projection as to how the home sales would go. But the reason why the mortgage rate will be rising is that the blue line is beginning to rise. Blue line is 10-year Treasury yield. And why is the 10-year Treasury yields rising? Because of one of the two reasons. First is a good prospect, which is to say, oh, vaccination is really working. We're going to have herd immunity. Economy will be booming in the second half of the year. That means all the bond investors don't have to park their money in the safest asset. Now they can begin to move the money around away from the very safe asset of 10-year Treasury. So that will be the good reason as to why the Treasury yields are rising. But the bad reason as to why it could be rising is stimulus, on top of stimulus, higher national debt, rising budget deficit, much of that financed by printing of the money means higher inflation. All this is, so stimulus is not a free lunch. It's coming at the expense of larger debt and printing of the money, and bond investors are beginning to become nervous. So which reasoning is correct? Probably some combination of both. But however you view it, blue lines are rising, which means inevitably 30-year fixed rate, the red line, will begin to inch higher. So the absolute low point of mortgage rate, averaging 2.7% last month, those days are over. If your consumers are saying, oh, I'm going to wait until mortgage rate drop back to 2.7%, it is going to be a long wait, or if it happens at all. So most likely scenario is absolute low point is over. By the summer, maybe 3.1%, and by end of the year, maybe 3.3%. So some steady increase happening in the mortgage rate. So be prepared for this scenario. Nothing is guaranteed. Forecast is always subject to error, but based on my analysis of the past historical events, what's happening to the 10-year Treasury, mortgage rate looks to be rising, but nothing alarming. If you were to say mortgage rate would be 3.3% by year end, first you say, I missed the absolute low, but 3.3 is still good. So I think people should put it in that context. Now, the difficult sector is the commercial real estate, like retail, office. You can see that Denver skylines is there, but it's empty. People are not coming to work because they're working from home. This will change the dynamics for your market. If people are able to work from home, it also means people could work from vacation home. How would you know whether I am at home or at vacation home? Why should the boss care? So if the new economy, even after the vaccine, is such that you don't have to come to office building 5 days a week, maybe some kind of hybrid, come to office 3 days a week, but on Mondays and Fridays, you can work from home. And if that's the case, some people in Denver will be saying, why am I here when I can be out in Vail, have a home in Vail, then commute for those few days? So this could begin to either change their residential choice, or another part is some people in Denver say, why don't I have a second home because I can utilize more frequently. Every weekend, Fridays and Mondays, I can use more, therefore it is worthwhile. So this is a very good prospect for your area in terms of the work from home flexibility. I think that will begin to transform some of the residential choice. Twitter, aside from free speech arguments, just in terms of their company policy, they are saying that you can work from home forever. So why should somebody stay in San Francisco, high rent, high home prices, when they can go to Colorado and get, say, larger size home for even lower price? I know Denver, Colorado is expensive, but still cheaper compared to San Francisco. So you will begin to see some dynamics about this office leasing collapsing or underutilization of office, meaning that workers are working from home. And just for just completeness, residential prices, as you know, are rising, that's blue, but commercial prices are falling because rental income is not coming in or the vacancy rates are high. So just keep that in mind. So let me wrap it up by going with a forecast. Economic forecast, first 2020, recession. Down on the GDP, that's the middle column, down on jobs, low interest rate, no inflation. As we go into 2021, economy will be positive because of stimulus and vaccination. But the interest rate will be a little higher because stimulus is not a free lunch. And the inflation also begins to edge higher. As to the housing market forecast, 2020, the middle column, quite amazing. In the midst of a pandemic, high unemployment, everything turning positive because of low interest rates. Then in 2021, this year, mortgage rate will be ticking a little higher. I mean, it was 2.7% in January, maybe 3% very soon, and maybe 3.3 by year end. New home sales, builders build it, even with a clause on lumber prices, you can easily make a sale. There's strong demand for new homes, which also means that as people buy new homes, they're selling their existing homes, putting it on the multiple listing service so you can do your business. So existing home sales I went through the logic as to why it would rise 15%. And home prices, with more supply coming in, perhaps the price growth will not be drastic, but it will be more moderate. I know last year, Vail region clearly outperformed the rest of the country. I think your unit sales were up 20%, median prices were up 20%. So clearly you did better than the rest of the country. But part of that reason could be this new work from home economy. So thank you for allowing me to share some of the thoughts with you. And now I will turn it to either Erica or Laura.
All right. Do you have a few minutes for questions, Lawrence? Would you mind? Okay.
Yeah, sure.
We did have one question come in over chat here, so we'll ask that. And then we do ask if you just raise your hand, we'll unmute you and you can ask Lawrence your question yourself. So the first question was from Tim Klunder. What formula do you use to calculate average sales price appreciation for Eagle County?
For the Eagle County, I mean, the figures that I showed you are all from national figures. So median prices are just, straight down in the middle. So of all the transactions, what's the median price? For Eagle County, I looked at some of the local reports that was generated, and it's showing about, 20% median price growth. Now that is tilted upwards because more $1 million home sales occurring. So it tilts the value upwards. The repeat price index, which would show sort of price appreciation of a typical home, is not 20%, or it's not even 13%. I think it's more closer to 8% on average. So a typical homeowner would see about 8% increase in value, but from your business revenue perspective, it's rising about 20% because the income is based upon the price.
Okay. Thank you. Does anyone have any questions? Looks like Alex Griffin. When do you forecast all of the stimulus, national debt, and higher inflation catching up to us?
So I think there will be a lot of disagreement as to the timing of it. But we remember the 1970s, similar situation, Vietnam War, large spending, and the war on poverty, large spending. And that led to large printing of the money. And you went to the grocery store, prices were up 10%. Then next year, again, 10%. So everything was rising 10%. But that led to bad economic outcome overall. So I think the Federal Reserve is well aware that they don't want to print too much money to get us there. But I think they will be willing to tolerate, say, 3% inflation, and we may just get there in 2 years. So inflation will be edging higher, but not like the 1970s. And regarding the national debt, America has that long history of credibility. And that is why we can print money and dollar does not self-destruct. Venezuela, they print money, it self-destructs. So America, because of the long history, but as we continue to print money to finance national debt, at some point, dollar could weaken, but I think it could, there will be early warnings of some steady declines before any alarming situation.
Okay. It looks like we got one more we'll take here. Robert Scheeling, do you think lumber costs and other building material costs to continue to rise through the summer, or do you expect that to relax with improving transportation?
So I will make that as the last question just for the timing purpose. I believe that prices will moderate. First, some of the wildfire out in the western state that limited the supply last year partly, and also the tariff that was placed on Canadian lumber made it more expensive. Now there is some reduction in tariff. I wish it would go down to zero. I mean, of course, we want to help our fellow American citizens in many aspects, but sometimes bringing imported products like Canadian lumber means more construction activity in Vail, means job creation in Vail, and more home sales for realtors. So it could actually lead to better economic prospects. So if they can reduce the tariff to zero, and furthermore, all the mills, the wood processing companies, I think they are ramping up capacity. So that should begin to also help moderate prices down the road. But in the short term, I mean, there could be still elevated prices for at least a couple of months.
Okay, well, we really appreciate your time today. We wish we could have had you here in Vail in person. It's been a while, I think, because I think the last time you were flying around Aspen and couldn't come in because of the bad weather. So hopefully next time we can see you in person, and we appreciate your time. I did have one question. Would you mind sharing your PowerPoint? Is that okay if we get that from you and share it with the group?
So I know the lovely place that you are living in. I'm jealous, here in Washington. But I will certainly send a slide over. Enjoy the area, enjoy skiing, and thank you for having me.
All right, thank you. Enjoy the rest of your day.
Okay, thank you.
And everyone that's on the call, thank you for being on today. We want to keep on providing you these kind of updates here, just to keep you up to date with everything. We did launch all of our education is going to be free for 2021. So, make sure to sign up for classes. We have all kinds of great opportunities coming up for you. So thank you for being here, and we will talk to you real soon.